What's up, everybody? It is not often that I agree with Redfin CEO Glenn Kelman, but today I kind of do. He said recently in an interview on Yahoo Finance that the housing market is in for decades of pain due to the central bank's aggressive rate hiking campaign. What the Fed did, Redfin CEO Glenn Kelman said, will have a 30-year tail on it. There's going to be low supply for a long time to come unless America really gets religious again about building houses. I'll add to that this actually started when the Fed cut interest rates during the pandemic to stimulate the economy, making money so cheap that the housing market went crazy with both sales and, more importantly, refinances. Without the super low interest rates, we wouldn't have this lock-in effect, preventing would-be sellers from putting their homes on the market because they don't want to give up those super low interest rates to then go buy something with a much higher rate. This has been strangling our housing market and keeping home prices super high. So who is really to blame for one of the most unaffordable housing markets in recent history? And more importantly, how's it going to get fixed? So today, we'll take a look at that interview in Yahoo Finance by Sheena Smith titled, "Fed's Inflation Fight Will Affect Housing Supply for Decades," says Redfin CEO, as well as Redfin's latest housing market update. We'll also talk more about the NAR lawsuit and how I think it will affect our housing market. So let's dive right in. The Fed raised interest rates 11 times in less than 2 years, thus causing mortgage interest rates to skyrocket. This was after rates had become so low that a lot of Americans refinanced. In fact, around 14 million mortgage borrowers refinanced their homes between 2020 and 2021, according to an analysis by a team of economists at the Federal Reserve Bank of New York, which dubbed the study the Great Pandemic Mortgage Refinance Boom. And there's a good reason why. Rates were at an all-time low during the pandemic, sinking as low as 2.65% for a 30-year fixed mortgage in January of 2021, according to Freddie Mac. So anyone who locked in one of these super low interest rates is holding on to their home, because to sell would mean giving up this insane rate that they would probably never get again. Top economist Gary Shilling told Yahoo Finance that the Fed's change in interest rate policy created a perfect storm for the industry, with higher rates prompting would-be sellers to stay put, as many have locked in ultra-low rates during the pandemic or in the years prior. The result is exacerbating an already low existing housing supply. The housing market froze and existing home sales fell to their lowest point in 30 years. The giant gap between current and past mortgage rates is creating artificial tightness in the housing market. It won't continue indefinitely, but it certainly is disruptive right now, Shilling said. That being said, things have finally started to improve a little as the spring market heats up. Smith writes that mortgage rates fell for the second week in a row, declining to the lowest level in more than a month. The average rate on the benchmark 30-year fixed mortgage fell to 6.74% from 6.88% the week prior, per Freddie Mac. As mortgage rates go down, supply is also starting to increase. New listings hit a 17-month high in February, while the total number of homes for sale rose to the highest level in a year, according to Redfin. So will home prices finally start to come down with this increase in supply? If you ask Kelman, not anytime soon. We need more listings, especially of single-family homes, he said. Consumer demand is still strong enough that prices keep going up. Home affordability is the big issue for almost every homeowner and every potential home buyer. We need more supply. The median price of previously owned homes rose 5.1% in January from a year ago, with all 4 U.S. regions showing price growth, according to the National Association of Realtors. So how far do mortgage rates need to fall until we get that much-needed increase in supply to make our housing market more affordable? Kelman believes that when they drop from 7% to 6% and then to 5%, it will unlock more inventory. There may also be some easing of the lock-in effect as people decide to make the move regardless of their low interest rate. Many of the customers that we're talking to today still don't want to give up their 30-year mortgage at 2.5% or 3%. But they've just outgrown the house and say they finally have to let go, he said. I do think that even if interest rates don't come down significantly, we're going to see a modest uptick in inventory. But to see a big gain, you're going to have to see a real drop in mortgage rates. And I don't disagree with him. We are definitely seeing more inventory, just not enough to make a difference in home prices, at least where I am in the DC area. And unfortunately, it doesn't look like the Fed's going to cut interest rates anytime soon. Smith writes that a series of hotter than expected inflation prints has bolstered the case for policymakers to delay rate cuts, according to Oppenheimer's John Stoltzfus. He told Yahoo Finance Live that he doesn't think the Fed will cut interest rates till at least its June meeting. A delayed rate cut suggests, at least in the near term, that mortgage rates are going to stay relatively high, therefore delaying a more substantial rebound in the housing market. Without lower rates, inventory will stay restricted, therefore keeping home prices high. The bottom line, in order to really impact the housing market, we need to build more houses. Fed Chair Jerome Powell agrees. He said as much while testifying to Congress earlier this month. The housing market is in a very challenging situation right now, Powell said. Problems associated with low mortgage rate lock-in and high mortgage rates and all that, those will abate as the economy normalizes and as rates normalize. But we'll still be left with a housing market nationally where there is a housing shortage. Moody's Analytics expects a total housing deficit of 1.5 to 2 million units this year, with a shortfall of up to 1.2 million single-family homes. We need more supply. The real gate on home sales has been the number of homes for sale, Kelman explained. According to Redfin's latest housing market update, the total number of U.S. homes for sale climbed 5%, the biggest year-over-year uptick since May of 2023, during the 4 weeks ending March 17th. The metros with the biggest year-over-year increase in new listings are San Jose, up 40%, Phoenix, up 31.9%, and Sacramento, California, up 29.9%. The metros with the biggest year-over-year decrease in new listings are Atlanta, down 4.6%, and Chicago, down 0.7%. Unfortunately, the increase in inventory has yet to bring down home prices in most parts of our country. The median U.S. home sale price is up 5.3% year over year, the second biggest increase since October of 2022. And the median monthly mortgage payment is just $31 shy of its all-time high due to elevated mortgage rates and home prices. The metros with the biggest year-over-year home price increases are San Jose, up 18.9%, Miami, up 15.6%, and West Palm Beach, Florida, up 15.3%. The metro with the biggest year-over-year home price decrease is San Antonio, Texas, down 1.5%. 41.3% of the homes for sale sold in the first 2 weeks, up from 40% a year ago. 25.9% of the homes for sale sold above the list price, up from 25% a year ago. And as for the repercussions of the NAR lawsuit settlement, we did discuss this in last week's video, but it seems like it's getting even more confusing as the days go by. If the new rules take effect in July, assuming the court approves it, buyers may have to pay for their own representation or go without representation at all. To be clear, sellers are still able to compensate a buyer's agent, but they cannot offer it publicly in the multiple listing services. Alas, the confusion. Some metros may continue to have a culture where the seller offers to compensate the buyer's broker, and some may not. Or there may be a middle ground where the buyer's agent offers them a list of services at different rates. The confusion continues with VA buyers who are not allowed to pay for their own representation. So either the VA is going to have to come up with some new guidelines, or the VA buyers are going to have to go without representation unless the seller offers to pay. This could put them at a severe disadvantage if they want representation and are forced to ask the seller to pay for it as part of their contract negotiation to buy the house. I mean, think about it. We are still in a competitive seller's market in a lot of parts of our country. If there is more than one buyer competing to buy a house, and one of the buyers is not asking the seller to pay for their representation, but the VA buyer is because they're not allowed to pay for it themselves, who do you think the seller is going to pick? Another confusing part of the settlement is that it requires every buyer to have a buyer-broker agreement. We already do this here in Maryland, so we're kind of used to it. But how does this work for unrepresented buyers? Here's what it says. Written agreements for MLS participants acting for buyers. While NAR has been advocating for the use of written agreements for years, in this settlement, we have agreed to require MLS participants working with buyers to enter into written representation agreements with their buyers. So if a buyer chooses not to have representation, who exactly is writing the offer? I mean, no one works for free, let's be honest. So who is it? And how are they getting paid? Will a buyer now have to hire a lawyer? I know in some cultures, in some of the metros in our country, people already use lawyers, but in a lot of them they don't. And if they have to pay a lawyer, how much does that cost? And this is important, will this lawyer or whoever is writing the contract have access to the proper forms that NAR provides to write the contract? I could go on and on about the multitude of confusing questions that are resulting from this settlement. If you missed last week's video, we spoke about the misrepresentation of a lot of articles and videos that are talking about how home prices are going to be slashed as a result of this settlement. It's not going to happen. So if you missed that, definitely check that out next. Thanks for watching. I do appreciate it. Bye!